Welcome to the 3Edge Week in Review for the week of August 5th. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3Edge Asset Management. Today, Steve and I will discuss the recent correction in the global equity markets, which began around mid-July, but picked up pace on Monday of last week. By the time the U.S. market closed on Monday, August 5th, the S&P was down by around 8.5% from its mid-July high, and the NASDAQ had declined by over 13% from its high on July 10th. The downturn on Monday began in Asia prior to the opening of the U.S. markets. So by the time the U.S. market did open at 9:30, it basically gapped down to what turned out to be the lowest level of the day. The decline was blamed primarily, but not exclusively, on the Japanese yen carry trade, which Steve and I will get into during today's video. Since Monday, though, markets have recovered some of last Monday's losses. For example, on Thursday, the S&P recorded its best one-day performance in almost 2 years with a boost from a better-than-expected jobless claims report. But, it's still an event that spooked markets, at least temporarily. So let me bring Steve in here. And Steve, we know that it was more than just one single factor that contributed to Monday's sell-off. But since much of the blame has been laid at the feet of traders and now, I guess, somewhat infamous yen carry trade, I think it would be helpful if you could just explain, exactly what is this yen carry trade and why did it cause so much damage?
The yen carry trade is a perfect example of how an event halfway around the world can impact us and really markets all over the world. So to dive a little deeper in the yen carry trade, basically, the Japanese central bank, unlike other central banks which have been raising their interest rates and trying to print less money over time since the COVID crisis, has continued its massive printing of money and keeping interest rates at a very, very low rate. And this has been very bad for the yen. The yen has declined tremendously over the last few weeks, months, and actually years. So in Japan, there's a situation where interest rates were near zero. The yen was declining. Hedge funds and other investment groups decided a risky but profitable trade could be if they borrowed money in Japan, paying almost no interest, and because the yen was declining, they would be able to pay back their loans with less money. It's better than free money. It's like they're being paid to borrow the money. And what they did with that money was to buy all kinds of risky assets all over the world. They bought a lot of Japanese stocks. They bought U.S. tech stocks. They bought Bitcoin. They bought other risky assets around the world. And frankly, the yen carry trade is not the only major stimulus that was impacting the stock markets, and one of the reasons why stock markets, by our measure, are so overvalued. It followed the Federal Reserve Board printing more money in a 3-year period than the previous 107 years. It followed other central banks with their massive stimulus. But it's continuing, and it didn't stop when other central banks put the brakes on. And these traders were using it to buy all these risky securities. So all of a sudden, Japanese central bank decided to raise interest rates from near zero to 1/4%. And although that seems like a very little, it's a major change in direction. And people are extrapolating that now they're going to raise rates much higher than just 1/4%. So the Japanese yen turned abruptly from 160 yen to the dollar to close to 140. And that was a major rise in the value of the yen, which meant all of a sudden these loans went from very, very cheap to very expensive. All the people who borrowed that money to buy all these risky securities were suddenly getting margin calls by their investment brokers saying, you've got to close these trades. And so we saw the massive selling. Now, key is that there's not a lot of accurate data on how much of this yen carry trade is taking place. So there's a possibility that only part of this has been unwound. So there might still be more shoes to drop.
Yeah, that's right. You never know in those situations. how much is there. Okay, so as I mentioned earlier, we know that there were other factors involved in the sell-off that did occur. So maybe if you could just describe what other factors were at play that precipitated Monday's downturn.
So 2 Fridays ago, we had an employment report in the U.S. that was a bit weaker than expected. An unemployment rate jumped up to 4.3%. And while that's still a low number, it's the highest number we've had in some time. And similar to every recession we've had over the last several decades, they all started with modest gains in the unemployment rate that then accelerated to more rapid gains. So people have observed this, and people have been conditioned to be on the lookout for any gains in the unemployment rate that could precede more rapid gains. So it spooked the markets that, well, maybe we are going to have a recession. Maybe this idea of a soft landing or a Goldilocks scenario isn't 100% guaranteed. So that spooked the markets as well as the yen carry trade, the idea that the recession was not impossible, that could still be out in our future. So one of the reasons why the market rebounded, as you mentioned, on Thursday was that another type of labor report came out. It was the jobless claims. It was just a little bit better than expected, but that was enough to send a sigh of relief. Well, maybe the recession isn't around the corner. And so we have this tremendous volatility. But as you mentioned in your earlier comments, even despite some of these rebounds, the market is still well down from its peak in July.
Yeah, absolutely. So, as always, my final question is: after Monday's downturn, and seeing that markets have bounced back somewhat, what should investors think about doing, if anything, at this point, based on what happened over the course of last week?
Well, I think it'd be appropriate for me to share two opposing schools of thought, and then to come down with how we're positioned with that. One school of thought is that over the last several months, we've had many corrections that were opportunities to buy the dip, meaning that as an opportunity to come back into the stock market, achieve a lower price, and ride the market to new highs. And that's worked spectacularly well over the last several months. And so investors are conditioned that that's what you do, and you get rewarded. So when we see a rally like we did on Thursday, we say, well, these are people who've been conditioned to buy the dip. They're optimistic that we'll go off to a new high like we have before. Perhaps the next inflation reading will be favorable. Perhaps the next unemployment report won't be so scary. Perhaps the Fed will cut rates no matter what, and we can go on with the market making new highs. So that's one school of thought. Another school of thought is that the idea of a recession is not impossible, that recession has been greatly delayed by fiscal stimulus, by, you can argue, the yen carry trade up until recently, by positive psychology and momentum, both in investors and by consumers. But eventually, there are signs that the global economy is slowing, manufacturing is slowing, consumers are acting a bit more stretched, and it's just a matter of time before the recession comes. However, that is not a requirement for the stock market to go down. We know, for example, in 1987, the stock market went down a very large amount, and there was no recession. And so our fear is that because by our measure, the U.S. stock market has become so overvalued that people have paid prices that are not justified by the growth in earnings or sales, that the market is more vulnerable to a correction than many realize. And our models are showing that not necessarily that we're predicting a bigger correction, but that the risk of a bigger correction is growing. And so we believe it's not appropriate to be fully invested in the market. And as people saw last Monday, the market can go down before it opens. It can happen over the weekend. Right. It can happen overnight. You think you can always react in time, but that's just not the case. And history shows it's not the case. So we don't think this is the time to be fully invested. On the other hand, it's not completely out of the question that we have yet one more rebound. We go off to new highs before the ultimate peak. In 1999, a similar situation happened where people were saying the market is overvalued. Look, here's the correction. This is the beginning of a big bear market. It turned out to be temporary. The market did go on to make new highs. They did peak in March of 2000. Then people were convinced they never had to worry about a correction again. And of course, that was the peak. And tech stocks fell 80% after that. So we think it's better to not be fully invested, not be completely out of the market. Right now, in our core strategies, we are roughly in the midpoint between our lowest and highest equity allocations across the board. And we think that's a good place to be right now. And we'll keep watching, and our models will keep collecting and analyzing the incoming data to see if the risks rise or if they fall back.
Excellent. Steve, thank you. Thank you for helping us to better understand what transpired at the beginning of last week with the end carry trade and where the economy and the markets are now and could be headed from here. So that will do it for Steve and me for this week's edition of the 3 Edge Week in Review. As a programming note, now that we're in the month of August, we will be taking a short break from the 3 Edge Week in Review videos for the next few weeks in order to give some well-deserved time off to all the folks here who work so hard behind the scenes to get these Week in Review and View from the Edge videos recorded, edited, and distributed to our listeners. However, throughout the month, we will be sending out via email brief market updates, commentaries, and of course, should there be any extraordinary developments that could impact the markets, we will communicate our views. As a reminder, all our videos are available on our 3 Edge YouTube channel. If you know someone you think might enjoy and benefit from them, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.